Welcome everybody to this session of our Supply Chain Management Institute and Connected Systems Institute conference. We're pleased to have Tom Derry on the line. He's the CEO for ISM, which is the Institute for Supply Management. And he's got more than 30 years of experience in leadership and general management roles for both public, private, and nonprofit organizations. He's a 1986 graduate of Georgetown University's Walsh School of Foreign Service. So I'll hand it over to Tom. If you have questions throughout this presentation, Tom has been willing to take your questions, so don't feel like you have to hold them till the end. Go ahead and use that Q&A button on your Zoom meeting. You can put your questions there in the Q&A, and then Tom will answer them as we go through the presentation. So let me welcome Tom and hand it over to you.
Thank you very much, Mark. I appreciate it. It's a great opportunity to talk to professionals locally there in the greater Milwaukee area, and certainly there's a lot to talk about. I'm going to go through some proprietary research that ISM has conducted on the impact of the COVID-19 pandemic on global supply chains and some of the fallout, not just the pandemic specifically, but some of the other factors that have really snarled supply chains globally, as you all, I think, are very, very familiar. I'm going to cover a lot of data. So I want to pick up on Mark's comment. I would encourage you, if you've got a question or a comment at any point as I'm going through the presentation, to go ahead and enter that question in the Q&A box right away, because as I move through all of this data, I'm afraid that sometimes it'll be, the question you had at the front end might be forgotten by the time we get to the back end of the presentation. I don't want that to happen. I want us to have as much of an interaction as possible, in these virtual formats. So I encourage you to ask the questions or ask for clarification if I'm not making something clear, as it occurs to you. And I'm sure your fellow members of the audience will appreciate you asking that question. So without further ado, I'm going to get started here. There are multiple factors that contribute to kind of the very difficult situation that we're in today. And I'm going to begin by putting some things in context from an historical perspective, because I think it matters, and I think it's relevant. So this is a timeline that I've built that traces sort of the development of the global supply chain environment that we operate in today back over about 30 years. You go back to the fall of the Berlin Wall in 1989, then followed quickly thereafter by the collapse of the USSR in 1991, German reunification in 1990. These are all seminal political events, but they touched off a period of time where there was a lack of geopolitical rivalry, right? The United States didn't have a rival like it had in the Cold War, the USSR. And there was also a broad consensus during this period of time, I'll just highlight it here, on the benefits of international trade. And there was a kind of little questioning about wanting to open up new country markets, and with the lack of political rivalry that was a result of those political changes at the beginning of that decade, there was a very open environment for that. So we had NAFTA, now been replaced by the USMCA, of course, but NAFTA was negotiated in 1994. The WTO replaced the General Agreements on Tariffs and Trade in 95. The Euro was launched in 1999, and we kind of tend to forget how important that was in terms of knitting together the European economies in particular. China joined the WTO in 2001, and Poland, kind of putting a capstone on the end of the Cold War, Poland joined the European Union in 2004. So a former satellite of the Soviet Republic was now fully integrated into the European Union, which was kind of marked the end of that significant transition, and only really a period of 5 years. Now, if you move to or a period of 15 years rather, I'm sorry. So that's roughly a 2-decade period between 1989 and 2009. But I would argue that, speaking as a general matter, there was a global consensus around the benefits of international trade. I would argue in the last decade, we've seen that consensus begin to fragment a little bit. We had the Brexit vote in 2016, as you probably all recall. That was the people of England kind of expressing displeasure with the benefits of, or with the outcome of globalization, as they saw it impacting, basically the labor markets in Great Britain, and how people from Europe were coming in and taking jobs away from Great Britain, citizens of that country. So we had a couple of other significant events. These are not all of them I could mention, but they're, I think, the important ones. In 2010, China imposed export quotas on rare earth minerals. As many of you probably know, China has a de facto monopoly on the provision of applied rare earth minerals globally, not because you can't find rare earth minerals in other places. They're not rare in that sense. There are plenty available, but we don't like to mine for them. And China does not mind mining for them. So China, in effect, has a de facto monopoly. It was unhappy with the prices it was getting for those rare earth minerals back in 2010. And so it imposed export quotas to try to drive up the prices. Now, in 2014, that case was litigated in front of the WTO, and China lost that case in 2014. But it's worth noting that there's precedent with China in organizing its own economic affairs for what it sees as its singular benefit, and as opposed to the broader system. Even though President Xi likes to talk about the broad benefits of globalization, clearly China will act in its own interests when it feels it needs to from an economic perspective. And that's something to bear in mind. You notice on the left-hand side of this timeline, China's GDP was less than $500 billion in 1992. It had grown by a factor of 24 in 25 years. By the time we got to 2017, China's GDP was at $12.3 trillion at that point. It's approaching $20 trillion today, and is the second largest economy on the planet after the United States in 2021. On a purchasing power parity basis, easy for me to say, it's actually the largest economy in the world, and has been for some time, which many people don't typically appreciate or focus on. Another sign of the fragmenting of the consensus around international trade came in 2018, when the Trump administration launched its Section 232 tariffs on aluminum and steel for national security reasons, ostensibly national security reasons. And I would argue that this has sort of made it okay to use tariffs as a political weapon. And one of my favorite examples comes from a year later, when Japan imposed export restrictions on South Korea for some very critical components for high-tech products, for the components that go into our LED screens on laptops and phones, for instance, and some of the sophisticated processors and memory components, and semiconductor components that Korea relies on to manufacture its products, being an export-oriented economy as South Korea is. So what's interesting about that trade dispute is that what the underlying matter was a political issue. And it goes back to the treatment of conscripted labor, going back as far as World War I, and the use of so-called comfort women by Japanese soldiers on the Korean Peninsula during World War II. And the Japanese government maintains that this political dispute was settled by treaty some years ago, and there was reparations were paid, and the matter was handled and closed. And the Republic of Korea is now unhappy with the results of that agreement, and is raising pressure on Japan to reopen the talks around that topic. Japan maintains this position that the political dispute was settled, and resorted to use these export restrictions to ramp up pressure on Korea because they weren't responding, and so they've literally politicized the use of tariffs, or made tariffs something as a tool that we can use to deal with underlying political disputes as opposed to underlying economic disputes. So again, I think this was part of the argument I would make, that the pendulum that was swung very far to the right in terms of being in favor of broad international trade benefits for 2 decades through 2009 has moved back a little bit. I don't think we're going back to an era of economic nationalism by any means, but I do think that people have begun to question, even the Fukushima earthquake in 2011 began to raise some questions about, are we too concentrated geographically in certain industries in certain regions? And is the risk worth the benefits of lower cost we're getting from these widespread supply ecosystems? So I would argue that setting the tone for where we are today has been a change in, first of all, it's top of mind. Supply chains are top of mind for political leaders in all countries, also consumers in all countries. And there's a questioning of the benefits from the system as it currently today. Tariffs are still an important issue, even though we don't talk about them as much as we did back in 2018 and 2019. The Biden administration has not removed the tariffs that were imposed on imports from China to the United States. And they are at the 25% level for many of those components, which is a very high tariff level. In fact, higher than the margin of many of the companies that are importing those products. So they continue to be an issue. And I point out that while we're not maybe thinking about them as actively as we were when they were first imposed back in 2018 and 2019, they clearly are influencing, for instance, where we're standing up new suppliers. They're influencing the so-called China plus one strategy, where companies are finding an alternative source of supply outside of China, in addition to the supply they're maintaining in China. I do not believe that we're going to see a massive migration away from China. Yes, it's the world's second largest economy. Most people don't realize that General Motors sells more automobiles in China than it does in the United States. It's not leaving China. And our supply relationships are too important. Besides, the infrastructure in China is beautiful. If you've been to China at all recently, you know the highways, the airports, the ports are all brand new, modern, and fantastic condition, which is not the case for much of the infrastructure here in the United States. So for many reasons, I think China is here to stay, but I also believe that people, for a variety of reasons, including geopolitical risk, supply chain disruption risk, and others, are looking at a more multilateral supply strategy that will include an additional location outside of China. Sometimes that's in Southeast Asia, Vietnam or Malaysia or Indonesia. Sometimes it's back in the Western Hemisphere. Mexico is actually, there's some data indicates Mexico is winning some share, if you will, of the supply business from China as companies want to get closer to the end consumer here in North America. So how did we get into this mess? I'm going to talk about some of the economic and industry factors that have produced the current situation that we're in. There was the lockdown in China back in March of 2020 created a supply disruption that caused a very deep, but very brief recession here in the United States and globally. Then we had the fiscal policy change, particularly in the United States and other countries in the world, where stimulus checks were mailed to consumers, and that rapid economic recovery meant that we actually had more disposable income than we would typically expect coming out of a recession. And because we weren't buying services, we weren't getting our hair cut, going to the movies, going out to eat, we were buying things. We were buying electronic components so we could work from home, where the kids could be schooled from home. We were sprucing up our backyards and building decks. We're buying exercise equipment. And so they had actually a massive shift in the demand curve for manufactured goods. That's what this chart on the right indicates. But as you all understand, in the manufacturing environment, you don't stand up a new plant or add a new line overnight. And first of all, you want to make sure that the shift in demand is permanent. There's arguments made that it hasn't been permanent. And so we didn't have the capacity. So the global manufacturing capacity was overwhelmed by that demand curve shift. Similarly, global logistics were overwhelmed by the need to move things for a variety of complicated reasons. And then we had something that the academics call factor market rivalry, which led to disruptions and to significant price increases. I'll cover that in a little more detail as we go on. So I like to begin a talk around ISM's famous report on business. It's PMI data. And one of the reasons why it is so closely followed by businesses around the world, by academics around the world, and frankly, by the US federal government. ISM briefs both the Federal Reserve Board of Governors and the White House every month on this data because they're very, very interested in the implications for US economy from the data. It's the closest thing we have to a real-time indicator in economics of any type around the world. So you can see both the average PMI number, which is the orange line in this chart, and the average services, so manufacturing PMI and services PMI in the gray trend line on this chart, very closely correlate to movements in GDP, which is this blue line on the chart, over a year period. This is going back over 15 years at this point. You see how closely correlated the shift in the headline PMI indexes are to GDP movement. And as you can see on the far right-hand side of this chart, we're going to cover it again in a little more detail in a second. you can see the depth of, I have to move this bar over so I see it. You can see the depth of that recession in the second quarter of 2020, when the blue line, which is the GDP change, dropped by more than 8% on a quarter-over-quarter basis. And you can see the rapid recovery as we moved into the later part of 2020, with that blue line shot way back up. So that indicates the depth of that recession in the U.S. Now, one of the things I like to point about the data is that it correlates to economic growth or contraction in the United States, and you can use the index numbers that are published to do a quick calculation of U.S. GDP growth at the moment in time. So the Bureau of Economic Analysis came out with GDP numbers for the third quarter just last week, and indicated that numbers were at growth was at about a 2% annual basis. Our numbers are a little higher than that. This is data that was published as of the beginning of October, when the manufacturing PMI was at 61.1 and the services PMI was at 61.9. In those two reports, we published what those indices correlate to in terms of GDP growth over a period of time. And all you have to do is know the weighting between manufacturing and services sector of the economy, and you can do a quick weighted average of the two numbers, and you get this 4.6% number. So I would argue that the BEA number is going to be revised upward a little bit. It's not nearly as good as the 6.7% number we saw in the second quarter. I don't expect it to stay at 2.0%. I expect it to be revised upward based on ISM's data. Be somewhere in the threes, I would expect. But we'll see how that plays out over time. Anyway, as I failed to mention, manufacturing makes up about 12% of the U.S. economy, economic activity in the United States, and the services side of the economy is about 88%. So if you take the numbers in the reports and weight them by those factors, that's how you get GDP. I mean, that's how you can get real GDP at the moment the data is published, as opposed to waiting for data to be published 3 months later by the BEA and then revised several times after the fact. Now, I mentioned that we had a surge in, there's a demand curve shift and a surge in demand for manufactured goods in the United States. This data from the Cleveland Fed shows on average what the change is in the personal consumption expenditure, that's what PCE stands for durable goods. So things like automobiles and home appliances and computers and that kind of stuff. In a typical post-recession period, so you see the number was indexed at 100, and typically following that blue line, it moves very little from the onset of the recession all the way out to 14 months beyond the peak of that recession. But this time was very different. Personal consumption expenditures dropped dramatically in the first 2 months. That was during March and April of 2020, when we were in the depths of the recession here in the United States. But as you can see, at the 2-month point, it got back to where it was and moved to a very high level. And it's currently 35% above where it normally would be at a 14-month period out from the onset of the recession. So we've been spending more on these durable goods. And similarly, on the right-hand side, you can see our disposable income spiked. That's the reason we've been spending more, is we had more cash. And that was in large part due to two things: stimulus checks sent out by the federal government, and by our savings, because we weren't commuting to work, and we weren't eating out, and we weren't having to spend on clothing for the office and those kinds of things. So we had more cash savings, and we had more stimulus from the government, and we could spend more on things, and we have. Now, I'll point out on the right-hand side here where this blue arrow is, real disposable income has been coming down about a year from the onset of the recession, coming back to more normal levels. And so there's an argument to be made that we'll be getting back to historical patterns of consumption between manufactured goods and services, and maybe the demand curve is receding back to its more historical position. Now, some more data from the Cleveland Fed showing us for 3 particular categories of durable goods: motor vehicles, furniture and appliances, and recreational goods, the specific impact of the 3 rounds of stimulus. You can see, if you go back to my previous slide, you can see at 2 months out, our personal consumption expenditures started to grow rapidly, and that coincides exactly with the first stimulus check, as shown here in this Cleveland Fed data. And you see the second stimulus in January of 21 and the third round of stimulus in March of 21 also corresponded to higher levels of spending overall. So that has been moved through the economic system at this point. We're not going to see the continued spike in economic activity related to that because that impact has now been absorbed. We're still in manufacturing. We've got record backlogs of customer orders that we're trying to meet, but once those get fulfilled, we won't see this moving to the economy as dramatically as it has been over the past year. Well, how bad is it? Knowing that we had a shift in the demand curve, we had extra money floating around the economy, juicing the system. How bad is it? Well, we've been studying the impact on lead times in ISM since February of 2020, and the news here is that lead times really are not improving. We've done 4 rounds of research on this particular topic. In the second round, which was in late March and early April of 2020, lead times for China, which is in the green box here, were at 222% of normal, so more than twice as long as normal at that point in time. And you can see by the time we got into late 2021 and beginning of 2022, it improved from China slightly to 202%, but still more than twice as long as normal. And you can see in that fourth round of research, well, there's been some improvement in some places around the world. Even the best locations are still, we've got lead times that are 76 or 77% longer than normal to get product in. And there are a number of reasons. Early on, that was driven by the shutdown in China. So we had a supply-driven constraint on production. And later on, it's become a series of other factors, including shortage of commodities, more COVID-fueled shutdowns of ports and plants, and frankly, logistics being now a big contributor to the length of lead times. So lead times are continuing to be a significant problem for businesses. And we've seen that freight is contributing to that. So you can see in this, after we got out of the recession in March of April of 2020, even through the summer months, we weren't beginning to see people mentioning to ISM that they were having trouble moving freight particularly from China and from Asia to the West Coast ports of the United States. But beginning in September of 20, continuing all the way up to the present day, frankly, you can see that the concerns being raised in the verbatim comments that we collect on a monthly basis were rapidly increasing. It looks like I've got a question here in the Q&A box. I'm going to take that quickly before I move on. Yeah, in the motorcycle segment, does the trend of vehicles surprise me? Well, yes and no. I mean, on the one hand, it was very difficult, you might recall, to buy used cars and used trucks because there was a premium on people wanted to get the value inherent in buying a used automobile. So I'm not surprised, because I think people were using the extra cash they had on hand to turn over the vehicle. They felt that they could afford it more easily because they had the extra cash on hand and recognized this as an opportunity, even though they were driving a lot less. I mean, I got rebates on my automobile insurance, right, because I was driving a lot less. So that was very interesting. Thanks for your question, Angela, and I'll look forward to getting others as we go along. The second slide on transportation here is another view of sort of the same data. I don't expect you to really look at these small lines, but I want you to sort of look at the pattern. So if you go starting in July of 20 and moving to the current day through September of 21, the general arc you can see is, hey, people are complaining more about logistics and freight challenges than they ever have been. What this chart is, it breaks it down into the variety of categories of issues that people are commenting on. Are they general rate increases for ocean freight? Are they COVID-caused shipping delays? The lack of domestic trucking capacity in the United States, which is a huge problem for our U.S. economy. Higher freight costs in general. U.S. port congestion. You can see port congestion starting to become an issue last fall. Here's the green line in November of 20, and is at this point in time is it's as bad as it has been in recent history. Lack of air freight capacity continues to be a major challenge. We aren't flying passenger planes between China and Asia and the United States, and a lot of freight moves in the cargo holds of those passenger planes. We're getting blank sailings shippers hate blank sailings, but as a result of the COVID shutdown, we had a lot of containers, empty containers in locations where we weren't having shipping traffic, and we couldn't move those containers to places where they were needed. In addition, shippers were taking some container, expecting a large and sustained drop-off in international trade due to COVID. They were taking retiring containers that were ready to be, brought to end of life, and they took a lot of those off the market. So we had misallocated supply, and we had reduced supply of containers, and so we had, for lots of reasons, we had lack of ocean freight capacity, particularly between China and the West Coast ports. This is just a look at, as of the end of September, how things stood both in China and the West Coast ports. You can see it's actually congestion on both ends of the shipping lanes. What happens, particularly in certain ports like Ningbo in southern China, it'll shut down for a week or 10 days because of a single case of COVID-19, a single outbreak, and exports stack up during that period of time. And then they get released in waves, and they travel across the Pacific in these waves, and they get to the U.S. West Coast ports, and this is what we get here. We've got wait times at anchor in the San Pedro Bay area of about 2 weeks, and then you've got dwell time on the terminals themselves of about another week, and then you got trouble finding chassis to move these things out off the terminals, out of the port. So we've got multiple factors contributing to congestion on the West Coast of the United States. So that continues to be a problem. The president took some promising early steps by speaking to the port authorities, reaching an agreement to allow the union workers there to work on a 24/7 basis, and they weren't working weekends, they weren't working overtime. They were authorized to do these things, but the shippers and the beneficial cargo owners didn't want to have to pay the higher rates. But it really is a multifaceted problem. It's going to take labor, it's going to take the shippers, it's going to take the trucking companies, it's going to take the rail companies, all to coordinate their efforts to relieve the congestion over time. Long term, probably the solution is more port capacity and more automation of offloading of freight. But in the meantime, it's going to take all those parties coordinating together. I believe for it to really be effective, the president may have to step in again and bring all the parties to the table and get them to agree on measures that are comprehensive in their nature and not just single items. I'm going to pause for a moment there because I see there are a couple of, I see. I've been told to repeat the question. So thank you. When I get other questions, I will do that. Moving along. I want to talk about prices. So right now we've talked about lead times being still about twice their normal length at this point in time. We've talked about the contribution to that from global logistics mess ups and snarls. And now I want to talk about the third major challenge we're facing in supply chain, which is price increase. So we report, we link the overall level of the consumer price index in the U.S. economy to the services sector of the economy. That's the largest component of the U.S. economy, and you can see that they closely track over time. And you can see for a multi-year period going back to 2005, inflation, which is measured in the left-hand index on this chart, has bounced around between about 0 and 0.5%, with an occasional flare-up. Right in the end of 2008, it got above 1% for a brief period of time, but we've got a very long period of constrained inflation. And then we had this breakout that began in the spring of 2020 and has only continued to climb. Now, as you probably have heard, the Federal Reserve Board Chairman Jay Powell has maintained that he believes inflation is transitory, meaning that we're paying higher prices for inputs, for components and raw materials and ingredients, but that isn't going to translate necessarily to higher inflation that consumers will pay for their end products. And I'll tell you why I disagree with that analysis and why I think we will be seeing inflation at the consumer level for an extended period of time in a way that we have not seen for the better part of 2 decades. This chart here relates prices to lead times, and there's a couple of interesting things to point out. On the left-hand side of this chart, you can see that blue rectangle. That indicates when lead times slow. So the blue line is showing that lead times are dropping below the 50 level. And when lead times descend below 50, that means lead times are increasing or shortening, rather. I'm sorry, I'm shortening. And when they're shortening, you can see the prices tend to drop. And when lead times are shortening, it's because suppliers are having a hard time. The demand is dropping for their products, and they're trying to move the products to their existing inventory, and they're willing to lower prices to maintain sales. Now, the converse is true. Just to the left of that rectangle, you see the orange line, which is the spike in prices from the 2007-2008 timeframe, corresponding to a pretty good increase in lead times lengthening at this point right here. And that is generally a healthy sign of the economy. We see lead times lengthen broadly across the economy. That means there's been a change in aggregate demand. And in the short run, suppliers can't meet all of that change in increased aggregate demand, and they have to put their customers on allocation. And with allocation comes the ability to have some leverage on pricing, and they can charge higher prices. So normally we see lead times increase, that leads to higher prices, and that's related to the change in aggregate demand, which is generally interpreted as a positive sign for the economy, right? People are demanding more, spending more, that means economic growth. What we saw in the spring of 2020 was very unusual and the exact opposite. It's in the highlighted box over here on the right. We saw that prices dropped rather dramatically, while lead times at the same time increased rather dramatically. And that's because it wasn't a demand-driven change in the economy. It was a supply-driven change. It was a supply disruption. We saw the lockdown in China where we couldn't get things from China delivered to us, right? We couldn't get those orders fulfilled. So we saw lead times increase, but at the same time, because of the fear of a worldwide recession, what supply was on hand, people were trying to move by lowering prices. So we saw a very unusual pattern of a supply-driven event in the spring of 20. And then you can see as we moved into the period of economic growth and expansion after we got out of that recession, a more normal pattern of lead times lengthening and with a corresponding increase in price levels returned. So we're now out of that supply shock to the economy and back in the pattern, those charts I showed earlier where we had unusually high demand for manufactured goods in particular. And because that demand was artificially high, I would argue, because of the stimulus that was provided, it led to widespread shortages of commodities. Now, we measure pricing data at the overall economy level in our PMI reports each month. And you can see the numbers are near their all-time historical highs. You can see through 2020, prices were pretty stable. And in the back half of 2020, they noticeably began to appreciate. And still at this point in time in 2021, they're much higher price levels than we have been experiencing for quite a long time. This chart on the left-hand side shows that pattern around demand shocks to the economy versus supply shocks to the economy. But what I wanted to call to your attention are these two lists that we publish every month. It's the long list of commodities that are up in price. And it's also a long list of commodities that are in short supply. Those parenthetical numbers you see after each item are the number of months. So aluminum has been up in price for 15 consecutive months, to pick one example here. Adhesives and paint up in short supply for 2 months now. Plastic products in short supply for 7 months. Semiconductors, 9 months, but actually it's much longer than that because there have been some temporary improvements, but overall, if you track electronic components in general, it's going back a couple of years, we've had shortages in those particular commodities. Now, the thing that I want to point out about these lists is that they are so broad-based. It's everything from metals to industrial gases to lumber to electronic components to freight to pallets to plastic resins and other petroleum-derived products to agricultural products like soybean oil, rubber-based products. This is everything we need to make things in the U.S. And this is why I would argue that inflationary pressures are not transitory. I'm going to use one example. I mentioned factor market rivalry earlier. This, I think, is a very clear example of what is meant by factor market rivalry. Normally, the demand for lumber in the U.S. economy is quite stable. 1,000 board feet of lumber normally trades for around $400. Today, it's a little above $1,600 for 1,000 board feet. So 4 times as high as you would normally expect. Now, if I'm building single family homes and the cost of my lumber is up for a completed home by, let's say, $25,000, I can't pass that price along to the consumer, right? The house is only worth what the market tells me the house is worth. The consumer isn't going to pay higher prices for that home just because my prices for lumber are higher. And factor market rivalry, why are those prices higher? Well, it's because I'm still buying the same lumber I need to supply my construction business. Restaurants were building all those outdoor eating pavilions, and we were all upgrading our outdoor decks and upgrading our kitchens. And so there was a non-traditional surge in demand from DIYers at home and from restaurants, in addition to the existing sources of demand. And so you can't build sawmills that fast, right? There's plenty of lumber, but in the short term, capacity is constrained. So that's what factor market rivalry is, and we're seeing that play out in many different areas across the economy. When let's say resins are a component of the product I manufacture, and the cost of resins might be up even significantly for me by double digits, 15 or 20% year over year, let's say. Well, that's a big impact to my business, but it might be a small overall contributor to my cost of goods sold for that product, right? Maybe it's only 2% of my cost of goods sold. So even though I'm paying 20% more for resins, the actual cost to manufacture the product is only impacted very slightly. In that case, if 2% is a realistic estimate, then my cost of goods sold might have only gone up by 1%. I can't pass that along to my customer. But if I'm paying double-digit increases for everything I buy, not just a single commodity, then my COGS has gone high across the board, and my margin has been wiped out. I have to increase my prices and pass them along to consumers, because otherwise I'm not making any profit. And that's what's happening, I think, now. We're seeing across the board increases in all kinds of commodity categories, and that's why the COGS is under pressure. And we are seeing evidence that manufacturers and distributors and wholesalers are able to raise prices, and those prices are sticking with consumers. So this is something we haven't seen in the United States for a decade and a half, but it's here to stay. And I don't see, because demand is still relatively high and we're still working off backlogs, I expect inflation to be with us well into 2022 going forward. This is how one particular industrial manufacturer has been impacted by all these factors that I've been speaking to. So changes in lead times, increases in prices, the global logistics challenges, and how's that playing out in terms of performance? I asked this chief supply chain officer if he could give me an indication of like sort of pre-pandemic KPIs and post-pandemic KPIs, and give me an indication of the impact on his business. So for this company that has a diversified portfolio of manufactured goods in many different industry segments, their on-time delivery, which is measured by the customer request date, so the time they want to place their products with their customers, they want it to be 95%. That's their target. On a normal operating basis, they operate normally at around 92 to 94%. So they don't quite hit 95, but they're very close to it. When it gets to 91, that's a major crisis for this company. And there's all kinds of Kaizen events being organized to figure out what's going on. Today, they're operating at 79% on-time delivery to their customers. I mean, when 91% was a crisis before, imagine what 79% is right now. And this is an outbound metric and a lagging metric, because if I'm measuring delivery to my customers, all the problems that have caused my performance in terms of on-time delivery to deteriorate to this level have already happened right in my business up until this point. So this is measuring the output of problems that were pre-existing delivery to customers. He also looks at their past due backlog of products coming in. Pre-pandemic, the normal range is 0.5% of their supplies coming in were past due. Today, it's more like 2.7%. And that's a 5-time deterioration in performance there, which on a quarterly basis is equal to about 3% revenue decline on a quarter-over-quarter basis. So 12%, or a little bit more than that, on a compounded basis over the course of a whole year. That's a big deal, right? 12% decline in revenues is a big deal for any company. So, and this is indication. This is the inbound or the leading indicator, because they're not clear to build, right? one component that be missing from a bill of materials, they're not clear to build, they can't manufacture, and that's contributing to the outbound lagging metric of performance and on-time delivery. So one company's view, what all these factors add up to in terms of their operating performance and cadence. Now, how are companies responding to these circumstances? Well, they're responding in a couple of ways, and I would argue maybe not very optimally. One thing we started to see in the fall of 2020 and continuing into this year is this big change in the proportional relationship between purchase orders and invoices. I had a reporter actually share this data with me and wanted me to explain what's going on here. And I said, well, he thought there was something, maybe a financial explanation. And I said, no, this is very telling data, but you're not understanding what's going on. What happens is companies are ramming purchase orders down their throats of their suppliers, hoping to get more allocation, right? Hoping to get, and there's clearly some evidence, by the way, of some stockpiling. I'm going to talk about that in a second. But I can only invoice my customer when I ship my product. So because my capacity as the supplier hasn't changed over this time, you can see that my pattern of sending invoices has remained pretty stable and consistent from January of 2020 into late into 2021. That's because I invoice when I ship, and I ship when I make, and that's just the pattern. So purchase orders are about 40% higher than they ordinarily would be, because we're trying to win business from our suppliers in order to kind of assure that we've got stuff on hand, so we're clear to bill. I was talking to an automotive tier 1 supplier in the last couple of weeks. Their components that they provide to the automotive OEMs contain some sophisticated electronics, and like every other company, they're having a hard time getting hold of the chips they need to manufacture their products. One of their suppliers is Texas Instruments, and Texas Instruments said to this tier 1 supplier, you're on allocation anyway, just like everybody else, but you're not even going to get the allocation on the orders until we can audit your customers' orders. In other words, we want to see evidence that the orders the materials you're buying from us are proportional to the orders you're fulfilling for your end customer, the automotive OEM. If not, we think you're stockpiling, and we can't allow that to happen. We're trying to meet the need across so many different organizations. That's fairly unprecedented that a supplier would ask to see your own customer's order list and relate that to your orders in order to, but that's what's happening in this environment when we're trying to over order. We should stop doing that. We should order more on a kind of a hand-to-mouth basis. We know from ISM research that about half of firms, 49%, are intentionally holding more inventory than usual. So yeah, more indication that stockpiling is going on. I mean, I get that we're trying to assure supply so we can continue to build and manufacture, but half of firms are intentionally holding more than usual in terms of their inventory. That's suboptimal from a financial perspective. Your CFO isn't going to be happy about working capital, being used in this way. But I can understand, given the concerns we have about prices, we might be buying ahead because we figure we're going to beat further price increases. Our lead times and our transportation issues, I can understand why building some safety stock is appealing and attractive to companies at this time. I will point out that there's some academic research I just recently read that indicates most of us use or calculate our safety stock levels based on formulas that are embedded in our ERP systems. And our ERP systems use assumptions that do not align with our current circumstances and these economic conditions. So if you're using your ERP system to tell you what your safety stock level is, there's a very good chance it's too low. And you should go back and look at the assumptions that are being used to calculate safety stocks and see if you are maintaining appropriate levels, because your internal systems probably aren't calibrated to the economic conditions we're currently facing. So what does that mean for how do we get out of this mess? What's next? Well, there are really just a few factors, but they're all important, and I'm afraid they're not easily solved. So I'm just going to give you some final thoughts here on how we get back to normal, but I'm not optimistic that it's going to happen relatively quickly. I think we'll be dealing with a lot of these conditions throughout most of 2022, and possibly even into a little bit of the next year. So on the good news side of things, because container vessels are by their nature mobile assets, we're seeing ships being brought to the Pacific to West Coast U.S. shipping lanes. So actually, we're seeing some indications that ocean freight rates are coming down as more capacity is brought to those lanes. And I think that will restore some equilibrium in ocean freight over the next few months. I mean, it'll be into 2022 before it really gets back to kind of a normal situation. Could be 6 months or more from now, but we will get there. And that'll be one of the earliest phases of the overall recovery, which is going to be important. Secondly, we need more effective ways of dealing with these COVID-19 outbreaks and disruptions. When they hit a plant, that plant shuts down for a week, that's a week's worth of production that we're losing. It might be just my supplier, but when it hits a port, it affects everybody. We're seeing that still in China today, where ports are being shut down for a week or 2 weeks. So until we get to a place where we don't have these COVID-19 outbreaks, or they can be isolated, then that's going to continue to cause production to be spotty and uneven, and is going to lead to less efficient operation of supply chains overall. I don't see us restoring normal passenger flight operations in 2022, maybe by 2023. But we need those cargo holds to help with the overemphasis on ocean freight and to reduce. Chartering a flight now is massively expensive, even if you can find one to charter. So we need those passenger flights to return. I don't expect that to be until 2023 at the earliest, although, as you're probably aware, the Biden administration has announced the relaxation of passenger travel to the United States from Europe currently. So maybe we'll get there a little bit faster than that, but we'll see over time. Then capacity expansion has to happen in electronics. That industry has been chronically undersupplied in terms of capacity since 2008, 2009. Two things have contributed to that. One, we've seen a surge in non-traditional sources of demand for electronics. So it's not just laptops and cell phones anymore. It's all our connected devices. It's connected lighting on highways. It's connected appliances in the home. And all these our automobiles have something like 180 separate semiconductors in them these days. So we've had non-traditional sources of demand spring up, and capacity has not increased. As you know, it's very expensive to build a new fab. It's a multi-billion-dollar decision. You have to be convinced that the change in demand is permanent and real before you're going to do that. And the technology frontier changes so rapidly, especially at the high-end electronics products, that you have to be very convinced that the demand is going to be there before you build. And there's another contributor to this factor, which is we've been very successful in negotiating very low rates on many of these products. And in effect, we've robbed the manufacturers of electronic components of the margin they need in order to be able to invest in capacity expansion. So maybe we have to agree to pay a little higher prices to our suppliers in order to alleviate this capacity issue that we have in electronics. And because these fabs are multi-year construction projects, I don't see us returning to being able to meet the existing levels of demand until later of 2023 and maybe even into 2024. So that's going to be a continuing problem for many of us. As I mentioned, a positive sign is that disposable income. Oh, do we have a question?
Yeah. Hey, Tom, if I can just interrupt you here for a second, I'll give you a 5-minute warning here. And then we also have another question from the audience. The hand-to-mouth method is increasingly difficult with the issues in freight and raw material volatility. Do you think that safety stock will be recalibrated for good based on what we've experienced?
Yes, I think there are a couple of factors that are going to change the way we think about safety stock. I think there are two schools of thought around how we handle the risk of disruption in supply chain. One is that since COVID, we've learned our lesson, and we've realized that there's a price associated with having disrupted supply. We might have stock out, right? If we're a consumer packaged goods company, for instance, we run the risk of losing market share to our competitors. And so some people are kind of factoring in the risk, the price of that risk of having supply disrupted, and saying, I'm willing to pay a little more. And by the way, not not allocate or leverage all of my spend volume with a single supplier, maybe have two suppliers so that in case of a disruption or a risk of disruption, I can ramp up production with a second supplier. Now, that's not as cost efficient overall, but some companies are saying the risk of being disrupted, not being able to serve my end customer is more to me, or quantified at a higher level than the extra cost associated with maintaining that additional source of supply. So I do think that's going to be a factor. I also think that the current mix of economics is so unusual that we are miscalculating what should be the appropriate level of safety stock going forward. That being said, it's very hard for companies to maintain higher levels of inventory over a long period of time for the obvious reasons, but it's a drag on the P&L, it's a drag on the balance sheet. So time will tell whether people feel that the risk of disruption is significant enough and willing to pay a little more, especially if I'm able to pass that cost on to the consumer, or if the overwhelming dynamic of resorting to not being able to resist the pressure of lowest cost is going to exert its force over time. So I hope that answers the question. So I mentioned it earlier on, the disposable income is returning to normal levels. That's going to take some pressure off the manufacturing supply chain, which is probably a good thing. And that's already happening. So that's getting us back to normal a little bit faster. And then some commodities are more important than others. And I mentioned semiconductors already, the electronics industry in general. We know that automotive OEMs are shutting down plants right now, right? Because they don't have chips and they're not clear to build. We're seeing orders kind of spread through the supply ecosystem in a slowing down way. So tier ones are getting fewer orders from the OEMs. Tier twos are now getting fewer orders from the tier ones. And that's spreading throughout that supply ecosystem right now. That could lead to a mild recession. You know, the shortage of semiconductors for industries as big and as important to the U.S. economy as automotives, and we're not even talking about aerospace and defense and other types, that could spread to something that actually slows economic growth to a point where we're actually tipped the curves into a contraction. It wouldn't surprise me, just to go out on a limb here for a little bit, to see us experience another little contraction sometime in 2022 as we move through that year because of this ongoing shortage in electronics. So I'm going to stop there. We would be delighted to answer any questions or engage in any dialogue with anybody on the call today.
So I'll pause here for just a second. If you do have a question, please put that in the Q&A. Use that Q&A button in your Zoom link. While you're doing that, while you're typing, those of you that have a question, I'll direct your attention to the next hour while you grab a sandwich, if it's your lunchtime. Encourage you to tune in and see the tour of the Connected Systems Institute test lab. You can find the link for that in the email that was sent yesterday, or if you received it this morning. And then come back at 1 o'clock. You can hear Bill Stewart from Kohler talk about agile methods that they've used that have been extremely beneficial in helping the Kohler company be more agile in this turbulent time. And I think Tom did a great job of painting that picture of how turbulent and how challenging things certainly are at this time. I've heard supply chain professionals that have gone through what we've gone through over the last 18 months and said that they've gained 10 years of experience in the last 18 months. And so I don't think that's too far from the truth. I'm not seeing any additional questions from the audience. So I'll stop here. We'll thank Tom for his fantastic presentation. I learned a lot from it, and hopefully everyone out there did as well. So thanks for joining. Take advantage of those next two sessions, the next one being at noon, and then the last one being at 1 o'clock Central. Thank you, everybody.
Thank you, Mark.